Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Saturday, June 6th, 2026, and we've got some fresh market commentary for you from yesterday's data.
That's right, Ethan. Our AI has been sifting through a pretty active social media landscape. We saw a high volume of user posts flagging several different stocks, indicating a mixed but certainly engaged market sentiment. Some discussions were very optimistic. Others, well, let's just say a lot more cautionary.
Indeed. We've got a diverse set of companies on our radar today, from established tech giants riding the AI wave to some potential turnaround stories, and of course a few that are clearly facing some strong headwinds. Let's dive right in.
First up, we're looking at John Hancock Premium Dividend Fund, ticker PDT. This one generated a lot of buzz, over 100 hot leads, but it's a bit of a nuanced situation.
You know, Brooke, the discussion around PDT was mostly about the elimination of the pattern day trader rule. Users were celebrating the newfound freedom to trade more frequently, with some even claiming significant personal wins. There's definitely a community excited about the increased trading activity this could bring to the broader financial sector. And we did see some insider buying, a small net purchase, which is usually a good signal for a company.
I hear you, Ethan, and the energy around the rule change is undeniable for individual traders. But when we drill down into the actual company, John Hancock Premium Dividend Fund, PDT, the KPIs tell a different story that disconnects from that enthusiasm. We're looking at an extremely high debt-to-equity ratio of over 54. That's a serious red flag, indicating substantial financial risk. Plus, revenue growth is almost non-existent at 0.067, and net profit margins are razor-thin, barely above 1%. While it has an attractive 7.72% dividend yield, its sustainability is highly questionable with such low profitability and massive debt.
So you're saying even if the rule change somehow indirectly benefits certain parts of the financial industry, it won't translate to this specific fund's fundamentals?
Precisely. The core business simply isn't positioned for significant growth, and its financial structure is too precarious. This stock has consistently been rated stay away in our previous analyses, January, April, May, and just earlier this month, and I see no fundamental change to warrant an upgrade. The market commentary is about individual trading, not the company's business model.
All right then. For PDT, considering the company's underlying financials and the disconnect with the social media hype, our AI-generated insight is to stay away.
Next, let's turn our attention to SAT SpaceMobile, ticker ASTS. We saw about 23 hot leads on this one, and the sentiment was quite strong.
Strong indeed, Broke. It seems users are really voicing their frustrations, with many reporting significant losses. One post, ASTS fucked me, garnered over 500 upvotes, so the feeling is quite palpable. There was a glimmer of cautious optimism from one user, but that was overshadowed by shared misery.
And for good reason, Ethan. The KPIs for ASTS are quite alarming. The company is unprofitable with an earnings per share of negative $1.8 and a net profit margin of 0. Operating margins are also deeply in the red. Compounding that, the debt-to-equity ratio is extremely high, over 112, and the price-to-book ratio is a staggering 13.4 for a company that isn't making money. And what truly amplifies these concerns is the insider activity. Over the last 6 months, insiders have sold nearly 4.8 million shares, representing a significant divestment.
Well, a negative EPS and insider selling are certainly tough to spin positively. While the space sector can be exciting and innovative, the current financials and management's actions aren't painting a bullish picture, you know?
No, they're not. The recent news also highlights competitive pressures and questions about whether it's time to rethink ASTS. Our AI shows this stock has largely been a stay away or speculative gamble in past analyses, with the last several ratings being stay away. With these continued losses and insider selling, there's nothing here to suggest a potential improvement in its fundamental KPIs anytime soon.
For ASTS, based on the overwhelmingly bearish user sentiment, the dire financial KPIs, and significant insider selling, our AI-generated insight is to stay away.
Moving on to Alto Ingredients, ticker ALTS. This one had about 15 hot leads, and the discussion was quite different.
Now this is interesting, Brooke. The primary post on ALTS presented a very strong bullish case, calling it a value turnaround story and a hidden gem. The thesis is that Alto is transforming from a cyclical ethanol business into a higher-margin specialty chemicals and carbon capture company. Users highlighted recent positive net income and EBITDA. Critically, we see very strong insider buying, with over 5.9% of shares purchased by insiders in the last 6 months. That's a huge vote of confidence. Plus, a PEG ratio of 0.8 suggests it might be undervalued given its projected growth. I appreciate the enthusiasm, Ethan, and the insider buying is certainly a positive signal. The return to positive net profit margins and EPS is encouraging, marking the beginning of that turnaround. However, we cannot ignore the elephant in the room. Alto still carries an extremely high debt-to-equity ratio of over 36.5. While the company is shifting its business model, this debt burden represents a significant risk that could hinder its ability to fully capitalize on new opportunities or weather any unexpected downturns. Also, the stock has already had a massive run-up, 450% from its 52-week low. While the sentiment is bullish, it's worth asking how much of that upside is already priced in after such a strong rally. That's a fair point on the debt and the previous run. But if this transformation truly takes hold, those improved margins and new revenue streams from specialty chemicals and carbon capture could significantly boost future earnings, making the current valuation look even more attractive over time, The one relevant news article also supports a sustainable trend. Potentially, yes. The insider buying and the low PEG ratio are compelling. If they can execute on this transformation and start addressing that debt, it could certainly change the long-term outlook. This is the first time ALTS has popped up in our analysis, so it's a fresh look. Considering the strong insider confidence and the promising turnaround narrative, but acknowledging the significant debt, our AI-generated insight for ALTS is a cautious buy. Finally, let's discuss Oracle Corporation, ticker ORCL. This tech giant generated about 19 hot leads yesterday. Brooke, the bullish case for Oracle in our data is quite clear, its strong connection to AI. One user highlighted Trump's alleged Q1 purchase and Oracle's direct ties to the Stargate AI project and Pentagon clearance. Several news articles also point to Oracle's focus on AI data center buildout and a quietly built $553 billion backlog. This really aligns with a compelling AI plus tech thesis, suggesting significant future revenue potential. Their return on equity is also incredibly strong at 0.575, indicating excellent profitability.
While the AI narrative is certainly compelling, Ethan, and the backlog is impressive, we have to look at the numbers. Oracle's PE ratio is quite high at over 38, suggesting a lot of that future growth is already priced into the stock. Even more concerning is their extremely high debt-to-equity ratio, over 415. That's a substantial financial leverage that could create vulnerability, especially if the ambitious AI projects don't materialize as quickly or profitably as hoped. Recent news even mentioned the stock tumbling 10% today and sliding, raising questions about the pace of their AI data center buildout.
But with such a massive backlog and the strategic importance of government AI initiatives, couldn't these news events eventually drive strong revenue and EPS growth, making that PE more justifiable?
They could, Ethan, but the current financials, the recent market volatility, and the very high debt load demand caution. An analyst also lifted their price target but maintained a sector perform rating, and the new target was still below the current trading price. We've actually consistently rated ORCL as stay away in our previous analyses, going back to last year, including as recently as June 1st. While the long-term AI potential is there, the immediate risks and current valuation make it a challenging entry point.
All right, despite the long-term AI potential, due to the high valuation, significant debt burden, and recent stock volatility, our AI-generated insight for ORCL is to stay away. All right, Brooke, let's wrap up our hunt for today. Based on our AI's insights and our discussion, here are the stocks we're flagging for you. Investigate as buy? None. Investigate as cautious buy? Alto Ingredients, ALTO. Investigate a speculative gamble? John Hancock Premium Dividend Fund, PDT.
And that brings us to the end of today's Daily Hunt.
All right, remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us on the Daily Hunt for Multibaggers. We'll be back soon with more AI-generated market commentary.
Until then, happy hunting.